Welcome back to Strictly Money. The tone has been negative for much of September as investors fret over prolonged higher interest rates. We will soon get the GDP figures for July, which could show that Canada is already in a technical recession. To share his outlook on the economy and markets is Dennis Mitchell, CEO and Chief Investment Officer of Starlight Capital. Dennis, great to have you back.
Great to see you, Saijal.
So, what are you paying most attention to right now?
Well, I think the thing that has really driven markets, whether it be real estate or diversified equities, it has been inflation and the response to inflation by central banks around the world. So we've seen the most aggressive interest rate hiking cycle in history, and a coordinated interest rate hiking cycle at that across developed markets and even some emerging markets in response to their peg to the US dollar. So that has been the number one driver. That's what we're paying attention to. And fortunately, it appears that most, if not all of those hiking cycles are coming to an end, if not already, then this quarter.
Yeah, I mean, one of the reasons for this sharp sort of interest rate hike cycle is they've wanted the economy to slow down, and it sounds like it's happening, right? And, we're going to get the GDP figures out on Friday. I should note that we are taping this, so by the time it does air, we'll have the figures. What are you expecting?
Well, most of the central banks around the world have a single mandate, which is price stability, which is a fancy way of saying keep inflation at a target of 2% or about thereabouts. And so, with inflation having spiked on the back of fiscal stimulus and pandemic shortages, most central banks have been forced to hike rates aggressively to bring that inflation down. And to your point, Sajal, one of the byproducts of cutting inflation is slowing growth. Right? If you raise the cost of money globally, then economic expansion and economic growth and consumption all start to come down. But interestingly enough, the precursor to global growth slowing is usually employment declining, right? So you get inflation rises, you get interest rates rise in advance, and as a result, employment starts to wane, and as a result, consumption starts to decline, and economic output responds, and GDP growth declines. We are seeing a slowing in global GDP, but we really are not seeing cracks in the employment picture right now. And that has proved to be a challenge for a lot of central banks, most notably the Federal Reserve in the United States.
Yeah. And do you think that the fact that the economy or the work employment picture is resilient is actually creating a problem to bring that inflation down?
Well, I think it adds complexity to it. I mean, if you asked any central banker, they would tell you that, if I'm going to hike interest rates and slow GDP growth and try to tame inflation, if the labor market remains resilient, well, I'd take that because that's almost the definition of a soft landing. I think the concern right now is that how resilient the labor market has been. We're nowhere near losing jobs. We continue to, if we're looking at the US and Canada to a lesser degree, it's not that we're losing jobs, we're continuing to add jobs despite the aggressive policy response by central banks. So that just adds a little more nuance and a little bit of complexity to it. Added to the fact that inflation wasn't simply high, it was 2 to 3 and in some places 4 times the target rate. So a very, very high inflation, a very aggressive response, and what appears to be a very soft landing. I think central bankers, by rights, are a little suspicious of their ability to engineer a soft landing in what is historically a very challenged economic backdrop.
Dennis, you focus on REITs in particular, and along with the rest of the market, that sector has certainly seen some selling pressure in September. What's happening?
Well, I think you've hit the nail on the head. You've seen interest rates go up dramatically, and there are two effects that I think investors are concerned with. One is that rising interest rates are negative for all risky assets, right?
Yeah,
So
yeah.
rising interest rates are negative for financials, for industrials, for utilities, and for real estate as well. And then the second impact that investors are concerned with is that businesses that have a lot of debt in their capital structure should be more sensitive to rising interest rates. And so, yes, from your chart there, it's a pretty ugly chart showing that Canadian REITs in particular have suffered over the last year and a bit. And actually, what would be interesting is if you superimposed the Canadian 10-year bond yield over that chart, what you'd find is that they're going in inverse directions. So year over year, the Canadian 10-year bond yield has risen from about 3.3% to just over 4% today. And that chart has gone in the opposite direction, right? I think the concern for a lot of investors is that real estate businesses compared to other types of businesses tend to have more debt in their capital structure. And really, that's a function of the fact that there is so much predictability in the cash flow of REITs.
Welcome back. Dennis, before the break, we were talking about how investors in REITs do get concerned with the cost of financing going up, especially because REITs tend to hold a lot of debt. So I'm assuming the answer is look for those REITs or those companies that have a responsible level of debt.
Absolutely. And I liken it to when mortgage rates go up, and they have gone up significantly, and everyone just simply saying all homeowners or all mortgagees are doomed because interest rates have gone up. Well, not necessarily so. Those who don't have mortgages are fine. Those who have very little remaining on their mortgage are fine. And those who live well within their means, who can absorb the amount of increase in mortgage debt servicing, are also fine. So taking that example to REITs, real estate vehicles that have got no debt or very little debt in their capital structure will find very little impact operationally from interest rates going up significantly. And those that have got very low payout ratios have got the ability to absorb higher debt service costs without impacting their distributions to investors. In fact, they can continue to pay rising distributions and dividends to investors. So this type of market volatility that you showed on that chart creates an opportunity for investors like myself who are focused on high quality REITs with great assets, low payout ratios, low leverage, and a track record of growing their dividends and distributions. It creates an opportunity to buy those businesses at material discounts to what they're worth.
So let's talk about those opportunities then, Dennis, these high quality REITs. Are there certain industries that investors should be looking at? Where are the opportunities?
Yeah, I mean, you can approach it from one of two ways. You can say what sectors and industries are benefiting from the current economic backdrop, or you can simply just say historically which companies have performed well throughout entire business cycles. So if we want to start with one, we like the structural long-term drivers of cell towers, of data centers, of industrial REITs. And all three of them have got the same supply-demand sort of factors taking place. You've got almost insatiable demand, and you have limited supply over the intermediate to long term to undercut that. So if we're looking at industrial real estate, I think a lot of people have chalked up the demand for industrial real estate to e-commerce, and that is partially true. But it's also the emergence of middle class of a middle class across the world. We live in Canada, which is a developed market. There's a robust and established middle class of consumers in this country. But around the world, there are more and more countries where wealth is growing and a middle class is emerging, and they have similar consumer appetites. So as they consume more, the demand for products that are manufactured in China or in Indonesia, I'm wearing a pair of Nike Air Jordans right now. They're made in Indonesia. As the demand for those products start to shift to other countries that have got that emerging middle class, well, you're going to need more logistics and warehouse real estate between Indonesia and that country to house those assets and as they ship from where they're manufactured to where they're consumed. So that is part of it as well. When we look at cell towers and data centers, Saijal, 90% of the data that exists in the world today was created in the last 2 years. So you get an idea of just the sheer amount of data that gets created every day. You and I are in two different locations doing this interview over a hosted piece of software. Again, that is being hosted and on the servers of a data center somewhere else. So you can see the demand for data storage. Of the 5 or 6 billion people who access the internet every day, 92% of their access comes through mobile devices like tablets or smartphones. So you can see the utilization of the cell tower network to access all of that data and information. So we like the long-term structural drivers of industrial real estate, cell towers, data centers. There's tremendous demand, very little new supply. And as a result, you're seeing rising cash flows and rising distributions out of REITs in those three sectors in particular.
Okay. Des, we only have 20 seconds till the end of the interview. I want to revisit office REITs. Would you still stay away from it, or are you starting to see a shift as workers come back to work?
Yeah, I don't think there's been much of a change, but longer term, there will be quality office REITs that do survive and do endure. Whether now is the time to get involved or if you should be a little more patient, I think it's probably behooves you to be a little more patient, especially given that chart that you put up just now or just recently.
Okay, Dennis, always appreciate your insights. Thanks so much for coming on.
Anytime, Sajal.
Dennis of Starlight Capital.